Well, welcome back. This is the second part of the our lecture uh, of marketing economics course on the tendency of profit rates to fall. Last time I ended abruptly. That's because the um, 15-minute mark uh, well came before I could stop, and I actually was carried out with my remarks there. Well, basically, I was telling that the fall in C over V might help potentially increase the profit rate, which we will see in the coming parts of this presentation. And of course, we will see because this is on how the rise in organic composition will affect the profit rate. Well, before we go further, I want to show you. Next time we will see the connection between the profit rate and the C over V. And but I want to show you a little bit math basically, and also what it means for the whole economy, what C over V means, and what the constant capital means also, and what variable capital and surplus value also mean. Well, first, maybe I should show also you the what will happen if the value of the C over V falls, C falls. So that's well, if the value of everything, this is actually the case when we have a factory, let's say, which uses 100 labor hour worth of constant capital, 100 labor hour worth of variable capital, and 100 labor hour worth of surplus value is extracted, which means constant C over V, organic composition, is 1. The S over V, the exploitation rate, is 100%, and profit rate is 50%. Since it is S over V divided by 1 plus C over V. What will happen if we, for example, decrease the value of everything by 10? That's 10 times increase in productivity, an enormous increase in productivity. Well, nothing changed. The ratios remains the same from the perspective of the capitalist who, at the time when he or she is considering the profit rate, basically everything is the same. The production activity increase doesn't help him or her to increase the profit rate. But what could help him or her is if we just decrease the constant capital to 50. And this might happen not necessarily by changing technology, which will promote variable capital or labor to other inputs. It might also happen if, in general, the commodities that are used as non-labor inputs have a decrease in price, while commodities that are used disproportionately as consumption goods retain their price. As in other ways, the goods that are usually called in economics as capital goods have a cheaper price now, but the goods that are usually called as consumption goods have maintained their price level. This might happen just at price level, but it might also happen if there is a productivity increase in constant capital in let's say industries that are producing capital goods or let's say non-labor inputs. While that productivity increase doesn't happen in the other sectors, but in that case, the exchange value of the constant capital might also fall. Well, in that case, value-wise, physical amount of constant capital will remain the same, but value-wise, the constant capital will have lower value compared with other outputs and the variable capital, labor, as an input. Well, can this happen? It is difficult, mainly because constant capital or the non-labor inputs consist of variety of the commodities like electricity, land, food. If we are talking about the food processing plant, then the agricultural crops are also the non-labor inputs. Chemicals, machines, buildings. And in many cases, also it is difficult to separate the one commodity might serve as a non-labor input. It might also be a consumption good. An apple can be a consumption good if you buy and eat it. It can be it can be a capital good, or it can be a non-labor input if it is bought by a factory and the factory makes apple pie. Well, even for example, prepared meals might be a non-labor input if it is bought by a factory and served to its workers, basically. So there are the constant capital, consumption goods and the capital goods are very much intervened. I mean, especially when we are talking about the non-labor input as the capital goods. But one policy might make this possible, and that's the policy when the capital, if a good is used as a, or if a commodity is used as a non-labor input by an industry, basically the state might give tax incentive for those uses. For example, same gasoline might be taxed heavily when it is used as a consumption good, but it might be not taxed that heavily if it is used by the factories or corporations which actually use it as an input for selling something else. And that might, of course, in that case, the exchange value doesn't change, but price will change, and that will at least make it appear as if C over V, the organic composition, has decreased in the economic system. So this is one thing. Now let's look to something else. Let's now talk about this. What means for the whole? What does the V and S together for the whole economic system mean? Note that C is the constant capital or non-labor input. Let's say it for the whole economic system for any year, for example. That's all other inputs that were that will be produced before and will be used on that year for production basically. And V plus S is the value added by the whole economy to those inputs. Who adds value? What adds value? Or we might ask in general economic sense, but in the Marxian economic sense, we should just ask who adds value, because in non-Marxian sense, the capital can add value to the commodities, but in Marxian sense, only and only labor can add value. So if we have, for example, let's say 1 million people working, is it 1 million? It's 1 million, and each of them work on average by 8 hours. In that case, the total value added for the economic system will be equal to 8 million labor hours. Well, in that case, V plus S will be 8 million labor hours. In this case, what will be maximum possible profit rate? That's profit rate, by the way. Maximum possible profit rate is V plus S divided by C. Why? Because at most S, well, we already know that the profit rate is S over V divided by 1 plus C over V. Or we can also written as S divided by C plus V. At most, whole surplus value may be given to the. So at most, the whole surplus, the whole value that is produced by the economic system, can given to the capitalists. And in that case, what currently is V plus S in the economic system will be just S. So let's say 8 million is this initially actually divided by 404 million by 4 million, half and half. and let's say constant capital, for now let's assume is also 4 million. At most, we might have V as 0 and the S as 8 million. But in that case, our profit rate will be S divided by C, which is 200%. So our capitalists now just need to buy the constant capital, the non-labor inputs, the workers cost 0 in this case, and they will get all 8 million to themselves. So does this 8 million change? No, it is equal to the total amount of labor force plus the number of hours worked. It can only change if the population increases or the people on average work for longer hours. The productivity might increase. In this 8 million hours might mean more output, basically. But in terms of exchange value, is more output. So it can be, for example, previously we could have produced 1 million shares, which are worth 8 million hours. If we now produce 10 million shares at the same time, in that case, those 10 million shares are still have the value 8 million hours. In that case, in that sense, exchange value of the shares might not basically change, or the total value, the total value added in the economic system in 1 year does never change in Marxian sense. What about constant capital? What is constant capital in this case? Well, we should also note that this 8 million is total value added, and that is in Marxian sense again equal to GDP. So whole GDP is actually 8 million labor hours, which is equal to V plus S, which is distributed by capital and labor. So what is in that case constant capital? So in order to understand this, let's make a thought experiment. Let's say we have a factory that is we have one company that is cutting wood, and to cut wood it uses 10 labor hours, and then shape wood, and for that it uses a further 10 labor hours, and in that case then produce let's say furniture pieces, which is actually parts of furniture, which let's say it uses further 10 labor hours, and then assembles them, for which they use a further 10 labor hours. If this all of these actions are done by this company, and let's ignore all other non-labor inputs, V plus S for this company will be 40. And depending on the exploitation rate, this 40 might be distributed differently between V and S. C in this company, let's remember we have ignored all non-labor inputs, it is 0 in this case. What happens if we combine these two companies? These becomes one company, but we separate now. Let's say these other two actions are done by a different company now. So, I'm sorry. Pieces of furniture, let me write. So this is one company, but this new company will now buy inputs from the first company, which will be worth as an exchange value of 20. So in the economy now, for the first company, so this will be 20, C will be 0. For the second company, however, C will be 20, basically. So for whole economy, basically, V plus S is still 40. However, now we have C, which is 20. So we will see the consequences of this calculation in the next part. See you then.